Hey everybody, welcome back to another episode of You Are Your Greatest Asset, aka the And Asset. All right, so in this video, we are going to discuss the term rider. It is essentially the three-piece part to the internal workings of an and asset. First, we talked about the base insurance, and how that base is essentially directly related towards the death benefit. Then we talked about paid up additions, how the paid up additions is directly correlated to the cash. Now we're going to talk about the term rider. And the term rider is the one that becomes a little bit more complex because every single company that we work with, their term riders are slightly different. I mean, some have some of the same characteristics, but not all companies' term riders are equal. Some are different. Some are 1 year terms, some are 7 year, 10 year, 20 year. And they all just have a little slight different characteristics and nuances, which if you work with us, we can explain each one of those depending on the company we move forward with. But the one thing that I will discuss and share with you is just why the term rider is important and why you would even put one on in the first place. You're like, term, why would I put term insurance on my whole life policy? That doesn't make any sense. Like, what is the point of doing that? And I'm going to explain to you in this video exactly why we do that. So, in every single whole life insurance policy, when it comes to the and asset, our whole goal is to minimize the cost of insurance as much as possible and maximize the cash into it as much as we possibly can. Now, what the IRS will see is they'll look at the policy and sometimes they'll say, hey, you have way too much money going into this policy right now, like way too much money for how small this death benefit is. It makes no sense to why that's happening. See, the way we see it, we look at this as a place to store capital. The way the IRS looks at it, life insurance companies look at it, this is insurance. This is insurance at the end of the day. Like, that is where they see it. So although it is a place for us to store capital, and that's where our first and foremost majority of people that come to us, their mentality is, hey, I want a place to store capital, alternative to I can leverage, borrow against, use for business, real estate, growing myself. I am my greatest asset. The insurance companies and IRS still see this as insurance. So ultimately, the insurance in itself has to be large enough to still be considered insurance with the amount of money that we're putting in. So you can't put in $100,000 a year into a policy, but have a $100,000 death benefit. It just doesn't work that way. If you do put that much money into the policy, which is possible, the policy does what's called a MEC, a modified endowment contract. Essentially what that's saying is we lose out on all of our tax benefits when it comes to life insurance. So now we have to pay essentially ordinary income tax on life insurance. We also, if we're going to use it before 59 and a half, have to pay a 10% penalty. And now it just starts operating looking like a 401k or an IRA or things like that, which obviously that's not our whole goal. Our whole goal is to have our dollars grow tax deferred, be able to access it tax free, and to be able to store our place in a place that has tax advantages. So we want to avoid that MEC limit at all costs. So we don't want to put too much money into the policy for a too small of a death benefit to where essentially we overflow the policy, put too much money in, and now we lose our tax advantages. So what we have to do is we do what's called this little fancy little chopping it up, put the magic sauce on it, and put the sauce that essentially makes the death benefit larger, but at an extremely cheap cost. See, the base insurance, that's a very expensive death benefit. That costs us a lot of money, okay? But if we put this term insurance rider on there, we're able to increase the death benefit at a very, very cheap cost. So what we don't want to do is make the base higher, and therefore we have higher expenses, therefore losing less cash value. What we want to do is we then put on this term rider, put this term rider on there to increase the death benefit. Sometimes I've seen it as like a tenth of the cost, as cheaply sometimes with certain carriers, than what it would cost if we were just to increase the base. So the term rider is essentially just a way for us, I don't want to say loophole, but it kind of is a loophole to increasing the death benefit to where the insurance company, the IRS says, okay, there's a lot of death benefit on this now, and you are for the amount of money you're putting in. Therefore, you're not going to lose out on your tax advantages. So just think of that term rider as essentially as it is an expense. So just know that when we do pay for that, it does cost us some money out of our pocket. It is a normal expense. We are paying for that death benefit. If we do die and pass away, you are going to get more death benefit to your family. So that's the expense you're paying for, the give and take there. But ultimately, we put that on there for a specific amount of time. The length of amount of time we put it on there is going to vary per person, vary per contract, based off of our goals, based off of your age, based off of health ratings, based off of how long you want to put money in for. And those are all things that you have to sit down and work with somebody who knows exactly how to specifically design an and asset so that they can do it appropriately so the policy doesn't mech. So that is exactly what a term rider is. And I hope that helps give you the most basic understanding of why we put it on, what it is, and how it is the third part in regards to the internal workings of an and asset.